Welcome everybody on Facebook Live. I'm John Dobis from Forbes, talking at the Money Show San Francisco with Jack Ablin. He's the Chief Investment Officer of BMO Private Bank. Jack, good to have you here.
Great to be here, John.
So you're a pretty smart guy. You've been around for quite some time.
I claim that.
You claim it, and we've got tape to prove it. So right now, here we are, 8.5 years into a bull market. Interest rates still very low. Your indicators are still positive, more or less. Some question marks, but if you've got some money now, or if you've got some highly appreciated stock investments, do you let it roll? Do you diversify into something else like bonds or cash,
Sure.
gold, other stocks? What are you looking at?
No, we're going to let it ride. We've got high embedded gains. We don't want to necessarily take money off the table too soon. I think the big quandary, John, is really the cash. You got cash on the sidelines, what do? It's an expensive market. Do you want to chase it? And I would say anyone interested in equity investing should look overseas.
Right.
We have pulled money out of the U.S., went into international, developed and emerging, and I can't sit here and say that emerging markets or international are cheap, at least relative to their own history, but they are maybe 10 to 15% undervalued relative to the U.S. And they have
nice momentum this year too, right?
Nice
I mean,
momentum.
Europe is off to their races.
Nice
it looks like.
Momentum and fundamentals are improving. So a lot of the pieces are falling in place for the international.
With this huge monetary stimulus that we've gotten over, it's been like being force-fed through a sewer pipe of cheap money in the last decade, really. You'd expect inflation to be a little bit higher. Is gold or anything like that, any kind of an alternative that is a hedge against inflation, something that piques your interest?
Gold is a hedge against inflation. Apparently, Bitcoin is too.
Yeah, my lord, yes.
And so that could be one way to hedge. And if we do start to see some inflation, that's going to be an open invitation for the central banks to pounce. They're not there yet. This is the low wage growth and low inflation is keeping the central banks pretty much sidelined.
Right.
We're hearing from them in Jackson Hole, and it just doesn't seem like there is a lot of arm flapping going on over there.
What kind of catalyst can you see overseas that would cause the early momentum this year in Europe, for example, to continue, or Japan, or something like that?
Sure. I think part of it is, John, that a lot of that the monetary stimulus that we enjoyed early on in 2009, they didn't really get into the actual years later. And so I think a lot of their recovery and a lot of their equity market growth is kind of situated 2 or 3 years behind us. So I think that there's still a little more room to run there. And while we're bumping up against something like 31 new all-time highs this year, they're still situated probably 20 to 25% below their all-time highs. So perhaps there's a little upside there.
So Europe might be arguably 2.5 to 3.5 years behind the U.S.
That's our sense. Certainly from a monetary sense, from an economic sense, which begs the conclusion that perhaps their equity markets can run a little further.
All right, stock's still going strong, but if you're looking for new opportunities, maybe go overseas. Thanks, Jack.
Thank you, John.